I was out showing homes this weekend. I have been writing contracts. I have gotten contracts on my listings. Real estate is still happening here in Arizona.
It is still happening, Rebecca. As a matter of fact, we have received 12 purchase contracts in the last week and a half, and we fully expected that would slow down. But for many buyers who were discouraged because of multiple offers, they see this as an opportunity, if their employment is secure, to get out there and be able to purchase a home at a time where there's perhaps not as much competition.
Tara, she's telling me how she's going to tell me no if I write a contract and I want it done in 30 days. I'm not happy about it, people. Not happy at all, but tell me why, Tara. Let's explain it to our audience.
I just think it's really important for all of us in the industry to recognize that these are trying times for a lot of families. Most people have transitioned to a work-from-home environment. We're trying to set expectations with all of our referral partners and our clients that we need to remember that this is not a normal market. And the idea of a 30-day close, although, certainly there's a possibility if they're putting enough money down, there's an appraisal waiver, everything goes right. But we don't want to rely on that. And so we're really communicating, hey, let's set the expectation for a 45-day close of escrow. And if we can close before that, we are happy to accommodate. But let's be realistic. We have escrow officers working from home. We have a limited amount of notaries that are going to people's houses. And we're not signing in a lot of the title companies.
We had rates that had dropped to unseen rates. You guys were busy bouncing off the walls doing
Unbelievable.
refis.
Yeah, we started out with 30-day close of escrows, quickly went to 45 days, at one point hit 75 days, currently at 60 days, meaning if you call for a refinance, you can't even lock in for any period shorter than 60 days. We're setting very realistic expectations on our refinances, and primarily because we do want to continue to prioritize the purchase business. These families need to make a move, and we want to make sure they can do it in a reasonable and timely manner. But with that push for refinances, it's so crazy, Rebecca. What normally moves the market is not moving the market today. So normally, long-term fixed interest rates are directly tied to the movement of mortgage-backed security bonds. And with this stimulus package, which, by the way, is the largest stimulus package in American history, the feds came in and said, we recognize the importance of keeping long-term interest rates low, and we're going to come in and we're going to purchase mortgage-backed security bonds to do that. And they have come through big time. But what's crazy about that is there is actually a lack of supply and demand, if you will, for servicers who want to purchase those refinances and service them. And as a servicer, this is Bank of America, Wells Fargo, Chase, the person who collects your payment every single month. If you do not make your payment, they are still required to pay the interest to the end investor. In our retirement vehicles, if you will, it's likely that we have some mortgage-backed security bonds because they're considered a safe and secure investment. Our baby boomers, whose financial advisors said, hey, let's move your money out of the stock market, are oftentimes moving that money into the bond market. The bond market are just mortgages.
Right.
They're just, bundles of mortgages. Well, guess what? The servicer, Chase, Wells Fargo, Bank of America, still has to pay the interest to you and I in our 401ks. We seriously believe that 25% or more of families with this forbearance opportunity will attest to the fact that they've been financially harmed, and likely they have, and that they will not make their mortgage payments.
But some people that haven't may just be looking to take an opportunity not to make those payments, possibly.
Right.
And that's why the mortgage-backed securities or the servicers don't want to take on any more
take
loans.
on these new loans because they're taking on a financial obligation. So here's the deal, you guys. The feds are dealing with it. They made promises to come to the rescue of all of these various industries that have been affected, but I can assure you that these were unintended consequences. So while our industry was thriving, refinances like crazy, product offerings like crazy, everything came to a screeching halt. And it's definitely going to take a little bit of time in order to see the liquidity come back to the marketplace as a result of that.